Einstein Retirement Daily, where we curate financial, economic, market news, and topics for the information that we think you as a retiree should be attending to, paying attention to, and know something about. In today's podcast, what I'm going to discuss is 5 ways to manage inflation risk. So inflation is a very big topic right now, and we want to talk about what's something you could do about it. As always, if you hear something in today's podcast that causes you to want to take some action or make some changes in your specific situation, please, we insist that you confer with the appropriate tax, legal, or investment professional who knows your specific situation and can help you make those changes in a way that is most advantageous to you. Okay, inflation obviously is a big hot topic right now. A lot of this is driven from the fact that Social Security just got a cost of living increase of 5.9%, and that's an inflation recognized number. And historically, that number has trailed real inflation. So if Social Security is increasing by 5.9, obviously, we would anticipate that real inflation is actually considerably higher than that. So what are some things that you can do to help manage this inflation risk that exists today? One of the things that comes to mind, so number one, is to own equity in companies that can help you bolster against inflation. So they sort of like gain access to inflation in as real time as possible. So looking at stocks or companies in the materials sector kind of becomes a standout in principle for that reason. So not just making an advocacy for any company that's in the materials sector, but there are some companies that are directly a part of the supply chain and are going to, in a sense, gain access to that inflation fairly real time. And so it becomes a reasonable place to go with your dollars, your investment dollars, to capture that inflation effect. So, for example, we saw a lot with construction prices in the lumber and timber industry. So if you had owned some stock in lumber companies over the last year, those companies, did pretty well because of this inflation problem that we have. So that's just one example. But those are the types of things you want to look for in the companies you own equity in. Other would be real estate companies. So real estate, which we'll talk about in our number 2 strategy, is a scarce asset. And so companies that are owning real estate, so be careful, again, not every company in the real estate sector is going to be a good fit to capture inflation. But companies, especially that own real estate, can provide some insulation to you against inflation because they're owning assets that are scarce. And so it can bolster the value of their company and their books and can provide them additional opportunities in an inflationary period. Also, you want to be looking at companies with great financial assets, either good assets, great cash flow, things like that. And the reason why that's important is because one of the ways that companies combat inflation and the effects of inflation is to buy back their own stock. One of the primary ways that inflation enters our economy is by very low interest rates. And so you want to have companies in your portfolio that are borrowing that money because of low interest rates, and they're using that to do stock buybacks. Stock buybacks gets a bad rap in the news for understandable reasons. But on the flip side, companies not doing that in some ways adds some risk to their investors. So just be on the lookout for companies like that as well. Companies with great financials who have shown a willingness to borrow, to engage in stock buybacks. They're going to help you hedge your inflation risk better. Okay, number 2. So number 1 is to own equity in companies within certain sectors of the economy. Number 2 is to own scarce assets. So what do we mean by scarce assets? Well, precious metals is a scarce asset. We are still mining for things like gold and silver, for example, palladium, platinum, these other precious metals. But it's not as if, we can just conjure that up double our the amount of gold in circulation or available overnight. They can't happen. Unlike with the Federal Reserve System, for example, they can press a couple buttons and suddenly the money supply is duplicated. And so scarce assets provide an inflation hedge, because the assumption is as there's more currency or more dollars competing for those scarce assets, the value of the assets will go up in terms of dollars. So that will help hedge your inflation risk. Real estate, there's only so much real estate in the world, and there's only so much that's habitable. There's only so much with natural resources. There's only so much. And so unless we see waters recede and more land shows up, or we get some volcanoes and we create more islands or something like that, there's only so much land. So it's a scarce asset, and owning real estate can be a great way to hedge inflation risk. The last one maybe is a little controversial, but I'm going to bring it up anyway. Consider some cryptocurrencies. I would say that in my review of things, Bitcoin makes the strongest case as an inflation hedge, but this would be something that should also be considered as a scarce asset. Okay. The third strategy is probably going to surprise you. It's maybe a little counterintuitive, but do not stress about debt. If we are in a high inflation period, debt is not your enemy. In a lot of ways, it's your friend, because what you can do with debt is you can accumulate assets. So in the same way that a company would take on debt to buy back shares of its own stock, buying more equity, essentially, if companies are doing it, big multi-billion-dollar corporations, there's a reason. And so the probability that this is something that could be helpful to you in your own personal finances is pretty good. So a little counterintuitive, but do not stress about debt and inflation period. Because inflation erodes the value of currency, your debt is held in the currency. So let's say you have $100,000 of debt, and we have a 5% inflation rate, simple interest over 10 years. What has happened over the next 10 years is that $100,000 debt just got cut in half simply because of inflation. Okay, only because of inflation. So debt is not your enemy in an inflation period. Okay, so we've talked about the first three. Number one, own equity in certain sectors of the economy. Number two, own scarce assets. Number three, don't be afraid of debt. Debt is not your enemy in an inflationary period. Number four, when you use fixed income solutions, okay, gravitate towards solutions that have some inflation protection mechanisms. Either if you're using alternative strategies, just things that are going to do a better job of keeping up with inflation, but also keep in mind that there are some simple things like, for example, tips. Having tips in your portfolio, treasury inflation protected securities, can provide a hedge against inflation. You can get a little more complicated if you have pensions, and your pension option offers you a cost of living option, maybe a smaller payment today, but includes a COLA or a cost of living increase year after year. Maybe that's the smarter selection to make. If you're going to use products like annuities with guaranteed income, you want to really strongly consider using that COLA, that cost of living increase option, rather than the straight guaranteed income with no cost of living increases. Okay, so look for things that are going to have inflation hedges in your fixed income solutions. Okay, the last number five. Number five is consider your long-term expenses. Think about it like this. If inflation is pretty high over the next 10 years, yes, things are more expensive. Yes, maybe you didn't get to go on the 10-day cruise. You had to go on the 7-day cruise or the 5-day cruise. Yes, maybe you didn't buy that boat you were hoping to get, but you got a smaller one or something like that. Okay. The point is in the short run, it's not that huge of an impact. So the thing that you need to be mindful of with high inflation is the long-term risks. So think about the things that could be affecting you 20, 30 years from now, because that's when inflation gets especially painful. Good example of this would be something like healthcare cost, right? That's something that you're likely to deal with later in life. Is the effect of inflation going to drastically increase the price of your healthcare? Well, not certain, but probably. What about long-term care expenses? There's current research is saying that there is a 90% chance for a married couple that one of you needs some kind of long-term care expense. So what should you do about that? Think about those long-term expenses and consider, how do I make sure that I can take care of those needs? And then should I consider any kind of insurance? Is there any need that I should have or be thinking about to insure those types of risks? This is why people purchase things like long-term care insurance. And then they layer on top of that insurance cost of living adjustments. Okay, so that those types of solutions exist. And if there's a risk in your retirement plans that says, gosh, it doesn't look like it's too big a deal, unless inflation is much higher than we're expecting, these are the types of things that are worth considering. Okay, so make sure you're thinking about those long-term risks. Okay, again, to quickly summarize, the 5 things that you should be thinking about to manage inflation. Number 1, own equity in companies that do a good job of capturing inflation as it comes. Number 2, own scarce assets. 3, don't stress about debt. Inflation erodes debt naturally. Using fixed income solutions, make sure you're considering the effect of inflation. There are some fixed income solutions that are geared specifically around inflation, so consider that. And then think about the things that are down the road, the expenses that you'll have later in life where inflation is going to have its biggest impact. Okay, I hope you found this video to be helpful today, and we'll look forward to checking in and talking with you on another podcast. I have a few lined up, and so I'm excited to share these topics with you. And with that, we'll wrap up for today, and I'll see you next time.